Nick, cue the clip where Sachs and I basically said this may happen in January of this year.
The risk is to a recession, because if we overcorrect and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. That may actually mean that the market has effectively crashed already.
Hey guys, welcome back to Library of Wealth. Today we have Chamath giving us his prediction for the current market. Chamath has been pretty accurate, even predicting back in January the current crash and recessionary climate we're seeing now. We'll take a look at that prediction along with his investment thesis, and we'll see how that's going to affect the stock, crypto, and capital markets over the next few months. In this interview, Chamath tells us why he believes we haven't seen the worst of it, and with the increase in interest rates, we'll see a recessionary correction happen in stock and capital markets up until the end of the year. Make sure to stay till the end of the video to hear what Chamath's prediction for the current market crash, inflation, and how this recession will affect the financial markets and what's coming next.
We had negative GDP in Q1 for a whole host of reasons that can effectively be summarized by the fact that we are still trying to restart an economy at the tail end of a pandemic, and we're doing it in fits and starts. And so we have these small bursts of incredible GDP, which we had last year, and then contractions in the economy. The thing that's always been true about the United States is that we are a consumer-driven economic engine, which means that as long as people feel confident and they're buying things, the economy tends to do well and we tend to move forward as a society. When consumer confidence ebbs and people contract their spending, we are in a world of hurt. The last couple of years, we've had a lot of consumer savings, right? We've had a lot of money that's been pent up in the system, whether it's stimulus checks or, loan forgiveness, or all of this stuff has allowed people to feel much richer. And as a result, they've started to spend in dribs and drabs. The problem now is that because prices are so high, all of those savings have largely been depleted. I just sent you guys a text in the group chat of what consumer spending looks like, and consumer savings rather. And it tells a really, really scary story, which is that the savings boom is largely over. Personal savings rate fell to 6.2% in March, the lowest since 2013. What does that mean? Well, it means that the setup is there for us to sort of really contract what we are able to spend as a society.
One of the points that the billionaire investor really drives home is that the Federal Reserve has a difficult path moving forward because of the raising of interest rates by 400 basis points into a slowing economy.
I think now the odds even push further in this direction, that we could have more quarters of negative GDP. And all of a sudden, we're back to what we talked about before, which is a 2019-like scenario, where the government, or the Fed specifically, races forward to tackle inflation. And in 2018 and 19, it turned out to be a head fake. And by the way, in 2019, the stock market ended up more than 30%, up 32% or something like that. Crazy numbers. Here, and by the way, back then in 2019, China turned over. It looked like it was going to be a fast-moving economic recovery for China, and instead they sort of slowed down. We have the same thing here. We have a quarter of negative GDP. We have China in lockdowns. We have every company that's in the manufacturing supply chain ecosystem telling the world that we don't really know what this is going to look like. Intel today actually said there's going to be shortages in chips through 2024. I think it could be a very difficult path ahead for the Fed. How do you raise rates 400 basis points into a slowing economy? You could raise basis points 75 bips, maybe 100 bips, but it gives them very little freedom to operate without really tanking the economy.
Chamath reveals something now that may be unsettling to some, but he talks about the 4 big companies that are essentially keeping the market afloat. But that could also mean that because of exactly how much they control and the numbers we're seeing, that the market has already crashed.
That dynamic that we're referring to in this tweet, in that image, is called dispersion, which means, people may be confused when you hear, why are all these stocks down so much, but the indices are not down as much. And it's exactly for the reason that David just said, which is that underneath the surface, the mega cap techs consume so much of the market cap of these indices. So, the Googles,
Apple,
the Microsofts, the Apples, and the Teslas. Those 4 just clog up an enormous percentage. I think it's approaching 40% of these indices. And so underneath the surface, you have dispersion, which means you have these tale of two kinds of stocks. You have these 4 big mega caps, and then you have everybody else. And the mega caps are generating so much cash that they're just basically keeping the market afloat. So at this point, maybe there's a small silver lining, and that silver lining is that to be bearish right now is effectively not being bearish these growth stocks, because as we said, they've been just decimated. At this point, to be bearish the indices means very specifically to be bearish those 4 names and only those 4 names. And so that may actually mean that the market has effectively crashed already.
They knew it was coming in.
Yeah, the market knew when we talked about the sales that Bezos and Musk did, when we sold equities, we were saying, it's like you can't keep all of your money on the table all the time unless you have the durational wherewithal, meaning you're just not time bounded and you can just be there forever. And not everybody's in that position.
After the Fed raised rates by 50 basis points, the effects of quantitative easing could be seen all across the market because they were buying securities and giving people the money. Chamath makes another prediction now, as he believes we're about to see a period of quantitative tightening where they sell those same securities and get their money back.
An endowment could be in that position, but individuals with...
No, an endowment is not, because they have to create distributions every year, right?
I'm talking about the mega endowments where they, Ford or Harvard may not need to do this, but yeah, smaller ones might actually be operating. Memorial Sloan Kettering might actually be operating their budget from it.
Yeah, but just to go back to David's point, it's a really difficult spot. What is the Fed supposed to do? So they're probably going to tighten 50 basis points in May. That's relatively well expected. We'll be able to digest that reasonably well. But what do they say, to David's point? If they all of a sudden go on a crazy program of quantitative tightening, right? And what is that again? That's when, they were printing billions and billions of dollars, going into the market, buying securities and giving people the money, right? That's called quantitative easing. Now we're doing the opposite, right? Where they're selling and they want the money back. Now, the problem is what that does is that removes liquidity from the market. And when you remove liquidity from a market, you actually make it a little bit more fragile, a little bit more precarious, a little bit more price sensitive. And so it puts us in a very tough situation when the economy is slowing, when these guys may be raising rates, and then at the same time removing money from the system. It may be a lot for all of us to handle. And so I think that they're under a really difficult set of decisions. The federal government is great at setting incentives, right? And creating tax credit programs and incentives for private enterprise to invest money. But when they act as a direct market participant and start to actually direct capital flows and make decisions about how the capital market should work, it never ends well.
The Federal Reserve is focused on keeping inflation under control, which is making investors nervous as the U.S. economy gives conflicting signals about growth in the market. While you might expect more discussion about the Fed holding off on raising interest rates, all indications are that the Fed will be less reactive to markets than in the recent past. What do you think about Chamath's take on the current market? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.